Thinking about getting a bridging loan? In this video, I'm going to uncover all the reasons you should avoid them. So let's jump in. A bridging loan lets you purchase a new home while giving you the time to sell your current one. And it works by letting you first buy and then second sell your existing home. And it means temporarily you'll own two homes at the same time. There are three main benefits of a bridging loan. First, it gives you breathing room to sell your home. Generally, you'll have a whole year to do so, ensuring that you can find the perfect buyer for your home. Secondly, it eliminates the worry of selling your home without securing the next. Essentially, you get to purchase your new home before selling your existing. And finally, it allows you to take on more debt than the bank would ordinarily lend to you. It's because your assessment is based on your final position after everything is settled, and not at the peak when you own both properties. Let's break down how a bridging loan actually works. Say you own a home worth $700,000 with a mortgage of $100,000. You're looking to upgrade and buy a home for $1 million. The trouble is that your borrowing power is only $500,000. This is a maximum that the bank is willing to lend to you based on your eligibility criteria, and $50,000 in savings. A bridging loan is divided in two parts: peak and end debt. Peak debt is the total amount you owe when you hold both properties. In our example, we can see we need $1 million for the purchase plus an estimated $38,000 for additional costs. This means that the peak debt would be approximately $1.09 million. The end debt is what's left after you sell your initial property. And using our example, if the sale price of the original property is $700,000 with real estate agent fees of $25,000, the end debt would be approximately $413,000. And even if the peak debt was more than your maximum borrowing power, the bank evaluates your eligibility based on your end debt. Now we've covered the basics, let's deep dive into why you might want to think twice before getting a bridging loan. We'll use St. George as our reference point, and they're one of many banks offering bridging loans. However, the principles we discuss are common across all lenders. When you first apply for a bridging loan, the interest rate you'll hear pertains to your end debt, essentially what you'll owe post sale of your home. And as we can see here, rates here start from 5.94%. But there's a catch. Banks charge a different interest rate for the bridging period. And as you can see here, these rates start from 9.05%. Revisiting our earlier scenario, let's dissect the real costs tied to a bridging loan. As previously explained, we have a house worth $700,000 with an outstanding mortgage of $100,000. Our aim is to buy a property priced at $1 million and factoring in all relevant fees and charges with $50,000 in savings, the total amount we'll need to finalize the purchase is close to $1.09 million. Now, here's the kicker. As highlighted before, the bank charges a 9.05% interest rate for the bridging loan facility, and in this scenario amounts to $56,000 and is the real reason you'll want to avoid a bridging loan. Even if you have the bridging loan for a few months, it will cost close to $15,000 just for the convenience. And when you take everything into consideration, there's simply no justification. Many opt for a bridging loan simply because they're unaware that they have other choices. And here are 4 other strategies which will achieve the same result without the price tag. 1. Subject to sale. Whether you buy or sell first, include a subject to sale clause in your contract. As an example, if you're buying, condition your offer on the sale of your current home. This means that your finance on the purchase will be subject to the unconditional sale of your home on the sale. 2. Extended terms. Consider opting for an extended settlement duration. This is where you either agree to sell or buy your home with a longer settlement period. As an example, if you get an offer to sell your home with a 30-day settlement clause, look to extend this to 90 days. This will provide you ample runway to find and purchase your next property. 3. Simultaneous settlement. This approach might be uncommon, but it's entirely feasible. Simultaneous settlement involves buying and selling at the same time. Essentially, the funds from your sale directly facilitate your purchase. and is a great option as it allows you to avoid a lot of the fees, such as a bridging loan or having to rent. Before listing your property for sale, know the exact type of home you're looking to buy. Be specific in what you're after and have no more than 3 suburbs on your shortlist. You'll need to be a suburb expert to pull this off because the moment you list your property, time is of the essence. 4. Selling your home first. Another approach is to sell your home before you buy a new one. The biggest challenge is once you've sold your property, you'll need to secure a place to stay, be it a rental or moving back in with the family. The transition often brings additional expenses. However, there are ways to navigate this. One solution is to arrange a rent-back agreement on your property you're looking to sell. This means that the new owners would lease the property back to you for a predetermined period. You can establish a rental contract for yourself prior to selling. This ensures that the ongoing lease agreement is honored. But a word of caution, this might make your property less appealing to potential buyers, especially if the rent is under market value. And if you're looking for a great mortgage broker, here at Hunter Galloway, we can help. We service Australia-wide and don't charge a fee for our service. So reach out and call us on 1300 088 065 or visit us online at huntergalloway.com.au. Thanks for watching, and until next time, I'll catch you then.